All right, welcome to This Explainer. Today, we are unpacking a really high-stakes business mystery surrounding one of the absolute titans of the auto world, Toyota. Right now, this manufacturing giant is standing at a totally fascinating crossroads. We're talking unprecedented revenue highs on one hand, while simultaneously facing some incredibly severe pressures that are just squeezing their bottom line. Let's dive in and find out exactly how they're navigating this rapidly shifting landscape. Here's our quick roadmap to untangle this complex web. We'll be looking at the revenue-profit paradox, three major profit headwinds, Toyota's reverse import strategy, the hybrid bull case, and finally, we'll wrap it all up with the final investment thesis. Okay, Section 1, the revenue-profit paradox. To really set the stage here, just let this staggering number sink in for a second. For fiscal year 2026, Toyota reported record-breaking revenue of over 50 trillion yen. That is a truly massive scale. You would completely expect a company pulling in that kind of top-line cash to just be firing on absolutely all cylinders, right? Well, here is where things get super interesting. There is a stark divergence happening right now. In the first quarter of fiscal year 2027, the revenue engine was running incredibly hot, up 10.4% year over year to 13.53 trillion yen. But the operating profit, it actually dropped 8.8%, down to 1.06 trillion yen. So the profit engine is essentially sputtering. What this tells us is that, yeah, Toyota is selling more vehicles, and sure, they're getting a nice boost from a weak yen inflating their overseas revenue. But the actual day-to-day cost of doing business, that's rising way faster than their ability to cut costs or hike up prices. And to put this profit squeeze into a broader perspective, management actually just revised their full-year guidance upward to 3.4 trillion yen, up from an earlier 3 trillion estimate. But listen, they primarily cited favorable exchange rates for that bump. Make no mistake, that revision is basically a currency band-aid. Because even at 3.4 trillion yen, we are still looking at a massive, undeniable 20.3% year-over-year decline in profit. In fact, operating profit has now slipped for 5 consecutive quarters.
Which brings us to Section 2, three major profit headwinds.
So who are the culprits here? The crucial point is that three entirely distinct macroeconomic realities are slamming into Toyota's bottom line all at once. And these aren't just minor little speed bumps. These are significant, structural challenges actively draining profitability across the globe. Let's break them down. First up, and by far the heaviest hitter, U.S. tariffs. Toyota has explicitly attributed an estimated loss of 1.38 trillion yen to the current U.S. tariff regime. To translate that, that is roughly $9.3 billion in annual operating income lost. Evaporated. Losing nearly $10 billion in a single region is just a staggering blow to their operational efficiency. It's the single biggest drain on their North American profitability today.
Second, we're looking at intense geopolitical friction and supply chain chaos. Recent earthquakes back in Japan forced some really unfortunate production stoppages. And looking further abroad, the ongoing conflicts in the Middle East have heavily disrupted logistics. You combine these global events, and they essentially act as a giant tax on the entire system, driving up raw material costs, spiking shipping rates, and throwing major friction into a global supply chain that relies completely on precision.
And honestly, the impact in the Middle East isn't just a logistics headache, it's hammering actual consumer demand too. To give you an idea of how fast these geopolitical frictions send shockwaves straight to the bottom line, Toyota saw consumer sales in the Middle East plummet by a breathtaking 38.6% in just the month of May 2026 alone.
And that brings us to the third headwind, which might honestly be the most concerning one for long-term growth, the slowdown in China. Also in May 2026, Toyota's sales in China crashed by 31.7%. Now, China is Toyota's second largest market, and it is going through a massive structural shift right now. Local consumers are rapidly pivoting toward domestic Chinese battery electric vehicles, and they're doing it in the middle of a brutal price war. It's leaving traditional legacy automakers fighting tooth and nail just to hang onto their market share.
Section 3, the reverse import strategy. So how exactly is Toyota adapting to this? Well, under Chairman Akio Toyoda, management is rolling out a rather unconventional corporate maneuver called a reverse import. It's exactly what it sounds like, a strategic initiative to physically bring U.S.-made vehicles into the Japanese domestic market. For a legendary global exporter like Toyota, actively bringing cars back home is a really fascinating pivot. The explicit goal here is to help address the U.S.-Japan trade deficit, hoping to ease some of those trade tensions that are literally costing them billions. And the specifics are pretty wild. Toyota is officially planning to import 3 US-made models into Japan: the Camry, the Highlander, and the Tundra. In fact, Vice President Hiroki Nakajima announced they are going to modify the US-built Camry over to right-hand drive, aiming to launch it in Japan by the fall of 2026. They're targeting 10,000 annual units. Now sure, 10,000 units is a drop in the bucket for a company this massive, but as a symbolic gesture, it's highly strategic. It proves they're willing to adapt quickly to a very complex political reality. But through all this chaos, what really stands out is their relentless capital discipline. Despite the massive profit squeeze we just talked about, management is still fiercely protecting their shareholders. They recently announced a massive share buyback program, up to 1 trillion yen, along with plans to bump the annual dividend to 100 yen per share. That sends an incredibly loud signal to the market. Management is supremely confident in their long-term cash flow and their ability to weather this storm.
Section 4. The Hybrid Bull Case.
This brings us to Toyota's ultimate defense, which is their multi-pathway powertrain strategy. Look, while a lot of their competitors are currently just burning through cash trying to scale up loss-making battery EV divisions, Toyota stubbornly and smartly remained focused on a diverse mix. They're doing hybrids, plug-in hybrids, hydrogen, battery EVs, and traditional internal combustion engines. And guess what? Consumer demand for their high-margin vehicles like the RAV4 Hybrid and Camry Hybrid is still incredibly robust. This highly profitable strategy is basically acting as a brilliant, built-in hedge against the recent slowdown in global battery EV adoption.
And you know what? Wall Street largely agrees. Out of the 19 S&P Global analysts covering the stock, the consensus rating is a resounding buy or strong buy. The consensus 12-month price target for their Tokyo-listed shares is 3,626 yen, which sits at about an 18% premium to recent trading prices. Firms like Bernstein are even more bullish, targeting 4,200 yen, while CFRA maintains a $225 target for the ADR. Essentially, these analysts are completely pricing in the short-term pain because they firmly believe in the long-term payoff of Toyota's strategy and insane brand loyalty. Section 5. The Final Investment Thesis.
When you boil it all down, analyzing Toyota right now is really a tale of two distinct perspectives. On one hand, you have the optimistic crowd who sees all this as purely cyclical headwinds. If you believe the tariffs are just a negotiating tactic that will eventually clear up and that the Chinese market will stabilize, then Toyota right now is a hugely compelling value buy, a rare chance to grab a premier cash flow machine at a discount. But on the flip side, you have the cautious crowd who fears these are structural barriers. If you think global trade walls and Chinese consumer preferences have permanently shifted against them, well then a 20% earnings decline isn't just a temporary pothole. It is a massive structural red flag.
Which brings us to the ultimate question you have to ask yourself after reviewing all the data today. Is Toyota's current dip a glaring structural red flag signaling a permanent changing of the guard in global auto dominance, or is it simply a cyclical discount on an undisputed world-class manufacturing giant? It's an absolutely fascinating puzzle, and how it plays out is going to tell us a whole lot about the future of global trade. Thank you so much for joining me for this explainer. Keep learning, and we'll catch you next time.